Thank you for tuning in once again to What in the World is Going On. Today we are going to discuss on this podcast the ripple effect. What would happen if the Federal Reserve were eliminated? The Federal Reserve, often dubbed the backbone of the American financial system, has long been a subject of debate and scrutiny. As the central bank of the United States, it plays a crucial role in regulating the economy, managing monetary policy, and ensuring financial stability. But what if this influential institution were to suddenly cease to exist? The ramifications would be profound, rippling through every facet of the economy and impacting the lives of millions, from soaring inflation to volatile interest rates, or even the potential collapse of the banking system. The elimination of the Federal Reserve would unleash a cascade of unpredictable consequences. In this post, we'll explore the potential outcome of such a seismic shift, examining how the absence of the Fed could alter the landscape of finance, influence global markets, and reshape our daily lives in ways we can scarcely imagine. The Federal Reserve, often referred to as the Fed, plays a crucial role in the United States economy, serving as the central bank tasked with maintaining financial stability. Established in 1913, its primary function include regulating the nation's monetary policy, supervising and regulating banks, maintaining financial system stability, and providing banking services to the government and financial institutions. At the heart of the Fed's mandate is the dual goal, promoting maximum employment and stabilizing prices, which it strives to achieve through the manipulation of interest rates and the money supply. By adjusting the federal funds rate, the interest rate at which banks lend to each other overnight, the Fed can influence borrowing costs for consumers and businesses, ultimately affecting spending, investment, and economic growth. Moreover, the Federal Reserve acts as a lender of last resort, providing liquidity to financial institutions during times of crisis to prevent bank runs and maintain public confidence in the banking system. This safety net is crucial during economic downturns as it helps to stabilize markets and protect the overall economy from collapse. The Fed also plays a vital role in overseeing and regulating the banking sector, ensuring that banks operate safely and soundly, thus safeguarding depositors' funds. Through its monetary policy tools, such as open market operations and reserve requirements, the Fed can influence banks' lending practices and, by extension, the broader economy. Understanding the multifaceted role of the Federal Reserve is essential to grasping the potential implications of its elimination. The absence of such a centralized institution could lead to significant disruptions in financial markets, affecting everything from inflation rates to employment levels. As we explore the hypocritical scenario of a world without the Fed, it becomes clear that its contributions to economic stability are deeply intertwined with the functioning of the American financial system. Eliminating the Federal Reserve would send shockwaves through the United States economy, leading to immediate and profound effects on various financial institutions and markets. As the central bank of the United States, the Fed plays a crucial role in regulating money supply, setting interest rates, and overseeing the stability of the banking system. Without it, the immediate aftermath would likely involve significant volatility in financial markets. Investors would react with uncertainty, leading to a potential sell-off in stocks and bonds as they grapple with the implications of having no central authority to manage monetary policies. Interest rates would spike dramatically as banks would lose a reliable mechanism for borrowing and lending. This sudden increase in rates would heighten borrowing costs for consumers and businesses alike, stifling economic growth. Individuals looking to finance homes, cars, or education may find loans unaffordable, while businesses might delay or scale back investments due to increased costs of capital. Furthermore, the elimination of the Fed could lead to a liquidity crisis. Without a central bank to act as a lender of last resort, banks may become more risk-averse, restricting credit flow. This tightening of credit would have a cascading effect, wherein decreased consumer spending leads to lower business revenues, which in turn would result in layoffs and reduced economic output. On a broader scale, the absence of the Fed would also undermine the U.S. dollar's position as the world's primary reserve currency. Foreign governments and investors rely on the stability and predictability that the Fed provides. The result could be a loss of confidence in the dollar, leading to a depreciation that exacerbates inflationary pressures and complicates international trade. Overall, the immediate economic impact of eliminating the Federal Reserve would not only disrupt financial markets, but could also plunge the economy into a period of uncertainty, stalling recovery efforts and potentially triggering a recession. The ripple effect could touch every corner of financial life, emphasizing just how integral the Fed is to the fabric of the United States economy. The elimination of the Federal Reserve would have profound and lasting consequences for the landscape of monetary policy in the United States and beyond. Established in 1913, the Federal Reserve plays a crucial role in regulating the economy by managing inflation, influencing employment rates, and stabilizing the financial system. Without it, the framework that governs monetary policy would be radically altered, leading to a series of ripple effects that could destabilize the economy. First and foremost, the absence of a central bank authority would likely lead to a return to a more fragmented and disjointed monetary policies. Individual banks and financial institutions might attempt to set their own interest rates, resulting in a chaotic environment where monetary policy is no longer coordinated. This could exacerbate the volatility of the money supply and interest rates, making it difficult for businesses and consumers to plan for the future. The predictability of such a system could stifle economic growth, as businesses may hesitate to invest in expansion amidst the uncertainty of fluctuating borrowing costs. Additionally, without the Fed's ability to act as a leader or lender of last resort, the banking system could face heightened risks during financial crises. In times of economic downturn, banks may struggle to maintain liquidity, leading to a wave of bank failures that could further erode public confidence in the financial system. This loss of trust could deter investments and spending, propelling the economy into a cycle of contradictions that is difficult to reverse. The elimination of the Federal Reserve could also result in the loss of effective tools for combating inflation and fostering employment. The central bank has been pivotal in employing strategies such as quantitative easing and adjusting the federal funds rate to influence economic activity. Without these mechanisms, controlling inflation could become more challenging, leading to a potential hyperinflation or deflationary spirals. Such scenarios can have devastating effects on purchasing power and overall economic stability, disproportionately impacting lower and middle-income families. Furthermore, the international ramifications would be significant. The U.S. dollar is the world's primary reserve currency, partially due to the stability and credibility provided by the Federal Reserve. Its elimination could underdetermine the dollar's status, leading to a potential shift toward alternative currencies. And this transition could destabilize global financial markets and alter trade dynamics, with countries reevaluating their economic relationships with the U.S. In summary, the long-term consequences of eliminating the Federal Reserve would reverberate through the economy, impacting everything from individual financial well-being to global markets. The complexities of modern economies necessitate a central approach to monetary policy, one that the Federal Reserve has historically provided. The absence of such an institution could create an uncertain economic landscape fraught with instability, inefficiency, and risk. Eliminating the Federal Reserve would send shockwaves through the banking system and significantly impact financial stability across the United States. As the nation's central bank, the Federal Reserve plays a crucial role in regulating monetary policies, overseeing the banking system, and serving as a lender of last resort during economic turmoil. Without its stabilizing presence, the banking sector could be thrown into disarray, leading to heightening volatility and uncertainty. One of the immediate effects would be the potential destabilization of interest rates. The Federal Reserve actively manages the federal funds rate to influence borrowing costs for banks and consumers. Without this guidance, interest rates would fluctuate wildly, making it challenging for businesses and individuals to plan their finances effectively. This unpredictability could dampen consumer confidence, leading to decreased spending and investments, which in turn could trigger a recession. Moreover, banks rely on the Federal Reserve regulatory framework to ensure their sovereignty and risk management practices. In its absence, there would be a lack of standardized oversight, making it easier for banks to engage in risky lending practices without sufficient checks in place. This deregulation could lead to a wave of bank failures, as institutions with poor risk management may find themselves unable to cope with economic downturns or financial crises. The elimination of the Federal Reserve could also disrupt the payment system that underpin our economy. The Fed facilitates the smooth functioning of payment processing through its real-time gross settlement system, which ensures that transactions between banks are settled efficiently. Without this infrastructure, the resulting chaos could lead to delays in payments, affecting everything from payroll to consumer transactions, thereby eroding trust in the financial system. Additionally, the ripple effect would extend beyond banking to the broader economy and global financial markets. The U.S. dollar status as the world's primary reserve currency is partially a result of the Federal Reserve's credibility and policies. Without a central authority to back the dollar, foreign investors might lose confidence, leading to a depreciation of the currency. This scenario could trigger capital flights, further destabilizing the financial landscape and impacting international trade. In summary, the elimination of the Federal Reserve would have profound and far-reaching effects on the banking system and financial stability. From erratic interest rates to increased risk in lending practices and disrupted payment systems, the absence of a central bank could transform the financial landscape into a volatile environment, ultimately jeopardizing the economy, well-being of individuals and businesses alike. The elimination of the Federal Reserve would undoubtedly send shockwaves throughout the global financial landscape. As one of the world's most influential central banks, the Fed plays a pivotal role in shaping economic stability, not only in the United States, but also across the international borders. If the Fed were to disappear, the immediate aftermath would likely be characterized by heightened uncertainty and volatility in the global markets. First and foremost, interest rates would fluctuate chaotically. The Federal Reserve's ability to set benchmark rates and conduct monetary policies help maintain a semblance of order in the financial system. Without this framework, investors would struggle to navigate a landscape punctuated by unpredictable borrowing costs, leading to a potential credit crunch. This instability could ripple through stock markets worldwide, with foreign investors pulling out of the U.S. equities due to fear and uncertainty, resulting in a sharp decline in stock prices. Additionally, currencies would be affected. The U.S. dollar, often regarded as a safe haven, could experience significant depreciation and confidence dwindles. This scenario might lead to a surge in inflation for countries that rely on dollar-denominated trade, further complicating the economic dynamics in emerging markets. Countries with strong trade ties to the U.S. might find their economies reeling from the impact of a weakened dollar, prompting central banks around the globe to reconsider their own monetary policies in response. Furthermore, the absence of the Federal Reserve could disrupt global trade relationships. International trade relies heavily on stable currency values and predictable interest rates. Disruptions in the U.S. economy could lead to a shift in supply chains, affecting everything from raw materials to consumer goods. Countries that export heavily to the United States may face economic downturns as demand plummets, while importers could struggle with rising costs driven by currency fluctuations. In essence, the elimination of the Federal Reserve could not only reshape the U.S. economy, but also create a domino effect that could destabilize global markets. Policymakers around the world would be forced to react, implementing measures to mitigate the fallout. But the interconnectedness of today's economies mean that the repercussions could be felt far and wide, leading to a prolonged period of the uncertainty and adjustments in the global financial system. In contemplating a future without the Federal Reserve, it is crucial to consider the profound and far-reaching implications that such a monumental shift could entail. The Federal Reserve, as the central banking system of the United States, played a pivotal role in regulating monetary policy, managing inflation, and providing stability to the financial system. Its absence could lead to a myriad of challenges that could dramatically reshape our economy. Without the Federal Reserve influence, we might witness increased volatility in financial markets, as the absence of a central authority could result in erratic lending practices and unpredictable interest rates. This uncertainty could stifle consumer confidence and dampen investment, potentially leading to economic stagnation or even recession. Furthermore, with no central mechanism to manage the money supply, inflation could surge uncontrollably, eroding purchasing power and creating uncertainty for businesses and consumers alike. On a broader scale, the global economic landscape would also be affected. The Federal Reserve serves as a cornerstone of financial stability, not just within the United States, but internationally as well. Its elimination could lead to a power vacuum, altering the dynamics of global trade and finances as countries seek to redefine their monetary policies in this new reality. Ultimately, while some may argue for a decentralized approach to monetary policy, the risks associated with eliminating the Federal Reserve could far outweigh the perceived benefits. As we envision a future without this key institution, it becomes evident that the complexities of modern economies require careful management and oversight. The ripple effect of such a monumental change would not only reshape our economic framework, but also challenge the principles of stability and trust that underpin our financial systems. In navigating these uncertain waters, we must remain vigilant and informed, recognizing the intricate balance that central banks strike in fostering a prosperous and resilient economy. As always, thank you for tuning in to What in the World is Going On. If you enjoyed this podcast, please like and subscribe.